This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Hello guys, welcome back to Breaking Banks Europe. I'm Matteo Rizzi, the executive producer of the show. This is show number 41, and we are actually inventing a new format for this one. I'm joined by three super old friends, emphasis on friends.
Who are you calling old, man?
Yeah. I said emphasis on friends. Come on, I even had to Google emphasis. Come on. So I'm with, of course, Jim, Paolo, and Brett. I don't think that we should make an intro because Jim has a show that is as popular as ours. Brett invented the show. Paolo is all over the places, and he has a Game of Thrones sort of infrastructure. So he looks like an Hollywood actor. I just wanted to explain, how the format is going to work. This is just like us, and pardon the audience for this man cast, but we got a couple of ladies that drop out in the last half an hour. It was complicated to sort of balance this conversation a little bit. And the idea is that there are a number of topics that we saw in the press, in the newsletters, in sort of conferences and events that we don't go anymore. And we're just going to share our vision to it, building bridges. Bridges between, the two sides of the Atlantic Ocean. That's why Paolo and I are symbolically on this side, and Brett and Jim on the other. So let's go to the first topic, guys. As you can see, we are all unmuted because, hey, this is a conversation. So you need to keep up with maybe the not super perfect church-like sound. Okay, go first topic. I saw recently in a LinkedIn post that Revolut is publishing a very senior job description for an M&A director. Okay, and in that article, this guy was also saying that. It was more or less calculating that the runway of Revolut is at least 5 years. So, and this is linked to another topic that I'm pretty sure that Paolo will bring it on. So, is acquisitions a path for these digital giants? What do you guys think about it? And it is unplanned. So whomever wants to kick it on, maybe Jim as the only technical guest of the show.
He was going to say elder statesman, but I think he tried to avoid that for making the mistake about the old friends the first time. You know what? I think right now it's not just the digital giants, it's the digital middle market. And it's the non-digital middle market that right now is in a difficult situation. You have a lot of fintechs that were depending on funding from VCs. And the VC marketplace, while not gone, is certainly more selective. On top of that, and Brett and I have had this conversation before, we just don't even just have to look at the fintech marketplace, but the middle market of the banking world overall, because the middle market of the banking world is stuck because they have legacy cultures and they're falling behind on the technology side because they can't invest as much. So I think the big get bigger. There's still going to be the challenge of making money doing so. And the small can still get good segmentation ability and be able to serve their individual segments. But you look at this middle market, and I don't know where we define that middle market, in the fintech space or in the traditional banking space. But I think we're in for a big consolidation and a big fallout from a numbers point of view. And we have to stop judging things by number of branches or number of customers, because really it's going to get down to, as you mentioned, Matteo, the runway. What's the financial runway for any of these organizations?
I think myself, there is a battle that has been going on underwater between volume and value in the fintech ecosystem and in the banking space in general. You can see it this way. You can divide a bank into 4 business units: payments, lending, investing, and insuring. And they correspond to different intensity of the information asymmetry. That means the capability of clients to understand a value-added proposition. Now, payments is the most simple to understand, and no surprise that most of the initial fintechs, those with the highest evaluation, operated in the space of payments. Even the neobanks in the end, they go around that topic. But you need to be not just an hyper volume, an uber volume to succeed, because digital, the way you position the value, squeezes the margin to the limit. So it's not just lower cost. It's also lower per client revenue. The lending should be the next hot topic, because it's a bit more easy for clients to understand you give them money, but that creates a lot of risk management issues. So all of the fintech that try to move from payment to lending need to face the issue of what they really do in terms of the risk management, which is raising the concern of the regulators. On the other side, you have investing. People don't understand that much how finance works. Maybe there's nothing to understand, as I always say. And insurance, which is the most asymmetrical, because you need to explain people that have to die to sell them life insurance. So that makes the human to human still very relevant, therefore more difficult to go on digital. Now, if you look at that, it is clear that at least for the biggest players like Revolut and the others, if they don't become something else or an Uber volume, and it's difficult for them to become unfinancial, they will not be able to make it. Now, the prudential
You're not stealing my
regulatory...
thunder, are you, Paolo?
I'm giving you a hint. I've got insights about your brains, okay? So now you see, Brett, and I give it to you. The Prudential Regulation Authority in the UK just released a paper discussing the profitability of challenger banks, saying that they need to focus on reaching profitability in the coming 3 to 5 years. I don't remember the timeline, which is opening the door to a few things such as M&A and consolidation, because the Uber volume basically is needed. Now, I'm not really sure whether the UK has enough. If you look at the UK only, therefore it would be an internationalization of that type of activity. But I think this is given.
5 years saying going to happen.
Able to make it need to build value.
Look, why should startups in the financial services space be any different to Amazon, right? Amazon wasn't profitable for 20 years. So, why put that constraint on, like if people are prepared to fund them, then let them go, I say, because, we're talking about, the evolution of the market. But let's get back to your original question, Matteo. I think one great example of this, the way we sort of have to change our thinking on this is, keep in mind the financial services market globally is a $22 trillion a year business. And so there's massive room for, rejigging that based on the digital sphere. And there's going to be a lot of winners and a lot of losers. Right now, the biggest winner is Ant Group. We used to call them Ant Financial. Then they said they were Ant Technology. Now they're Ant Group. They're going to list in Hong Kong and Singapore. They're going to put up about 30% of their company, on the stock market, which is not unusual in terms of size for an IPO. But these guys are going to be worth something north of $222 billion when all is said and done. That makes them the largest privately owned company. It'll be the biggest, sort of private company that fintech, it'll be the biggest fintech IPO, certainly. It's probably going to be the largest IPO outside of, the Saudi Aramco stuff.
That's a depressed price.
Yes.
Because it got depressed because of the international dynamics between the U.S. and China. Come November, you really are going to be betting on who's going to win, because the dynamics are vastly different.
Yeah, if they'd listed in the U.S. as an example, right? Imagine what it would be, easily in excess of 250 billion in terms of valuation. But here's the point: is that they were able to do that because they've really been at the center of disrupting, as Paolo argued in his economic thesis he just gave us. They really have challenged the way we think about the basics of the financial services system, and they've done it very, very well. Now, everything aside, I met Jack Ma years ago, brilliant guy. I've been very bullish on Ant from day one, as you guys know. But here's the point, is that if you look at the value in financial services moving forward, it's not the balance sheet. Right? It's not those traditional measures that we've measured traditional banks by, assets, I mean, if you measured it just on assets, just alone, Yui Bao, the savings, product within Alipay wallet, that's bigger than most of the banks in the world. And that's just one small aspect of their business. Let's not, take all the credit and lending stuff and all that other stuff. Just that piece alone. Not to mention the fact they're embedded in all these wallets around the world, and they're aiming for 3 billion customers, right?
However, Brett, we might agree, I guess, that even the Chinese had to face the problem of the single point of failure of Alibaba. So they decided that Bao cannot be the only money market fund, because that creates a huge systemic risk. Because if for whatever reason people start withdrawing the money, you don't know what happens, uncertainty, a war, whatever, there will be a systemic crisis. Now, it is true that we've been measuring financial markets with a certain measure linked to the assets. However, even if you can detach the value generation for a company from the assets, the risk management is attached to the asset, and somebody needs to take care of that.
But risk management's algorithms,
between the two, right? It's not just algorithm, it's prudential decision making. Algorithms will never be able to manage risk because uncertainty cannot be put there. It's an entrepreneurial risk. And as banks can be systemic, we saw that in the past.
Depends what type of risk.
Creates, right? But think about payment. I'll give it to you, Jim. Amazon clearly is also a super company, right? But if it goes down, there will be a disruption. But more or less, I might not receive the piece of furniture that I was buying and I was waiting for. It's a settlement risk. But if a bank goes down, even one that processes payments, and I have my account and my money there, that's emotional. That cripples through society. It's a completely different type of problem, economically, socially, and politically. That's why I believe that, it's good to scale, but there are things that need to be thought through more clearly when it comes to digitization of all of these elements, because systemic risk has not been thought through sufficiently, and we should. Security first.
I would love you, Jim, to translate for someone who has not, who doesn't have a PhD from Harvard, basically what are the consequences of what Brad said? And it has been a little bit, elaborated by Paolo. So what does it mean? So if I hear Brad say, hey, why don't we treat fintechs like Amazon, meaning they haven't been profitable for 20 years, just keep investing in it, great. But then, in Europe, how do you choose between, for example, 5 banks that technically do the same thing, So let's, talk a little bit about we cannot possibly throw all this money to everyone hoping that the stronger will survive, right? Because the money has, especially right now, is not going to flow as freely as before. Jim, what do you think?
Well, I think Brett's right. You can't value every company the same way. I mean, for instance, as you see that Google's setting up a partnership with 6 banks, probably going to get larger than that by the time they introduce a platform issue. Well, is that now becoming a fintech company? And even more dynamically, are the companies they're partnering with valued higher because of the Google partnership? I think Brett's right. When you look at Amazon, the first 15, 20 years was all about acquiring as many names and their buying behaviors as possible. The profitability, the value of the company was based on what the potential of information is. So I think what you get down to, you look at Alibaba, they have a lot of information on their constituents within China. That's valued within China, but probably not valued nearly as much outside of China. On the other hand, you look at Google, if this partnership goes through and there's so much vague information about where's the data going to reside and how it's going to be used, but you look at Facebook and you look at their ad platform and the partnerships they're building, look at Amazon, look at Apple. The value of the company, I think Brett's right, is going to be determined by what the market values, not based on assets, not based on savings, not based on even number of customers, because the deeper the relationship, the more you're able to do with that, the better it's going to be. And that's why Alibaba and Ant is so strong, because they have so much data on their customer base based on their buying behavior, more than just the financial services end of it. In fact, the assets and liabilities of the bank may be the least valuable aspect of what people are buying into.
That's very true. In fact, I think, Paolo, if I can just jump in with a brief comment here, I think what we have to recognize is that, just like every other industry that has been transformed by technology, the same is happening to banking. Now, if you look at the top performing companies in the world, BATXs in China, the GAFAs or the FANGs in the US, they're all technology-led companies. Now, they focus on different industries and sectors. Ultimately, that's the difference here. We're talking about, fintechs are technology companies first. Ant is technology first. And so we have to assess them first and foremost in their interface as a business with consumers as technology companies and not as banks. I'll leave it at that.
Very short, because we want to change topic, I would say that Amazon is a special case because Amazon digitized or retransformed the way logistics and buying and selling operates, but doesn't make money there, makes money on cloud. So maybe the easiest and the closest example would be Goldman Sachs. You can digitize investing and lending, but where do you make the money as the margins go down? Maybe they need to build a marquee, so a cloud platform. So you see, the issue for banks here is that how can they transform but generate different type of revenues, which is not part of their framework, which is regulated, and those type of revenues are not available to them also by regulation.
Paolo, is it about the relationship with the customers then? So let's take that a step further. As T-Mobile and Sprint are now combining to offer mobile money, the mobile money platform, does that relationship get stronger? And do you value that overall company based on the fintech side of it, or based on the deeper relationship that these companies are having with their customers? That's why Amazon is building relationships they are on the financial side. That's why Facebook, that's why, Amazon are doing it. It's deepening the relationship. You look at the relationships overall in the Western world, and I don't think anybody's got more loyalty than Amazon, and they get value.
But financial relationships are not commercial relationships. So other banks move and jumpstart on the other side is the contextual banking that I've been learning from Brett, or they will be having a hard time in making sure that they're profitable using volume. So they need to look for value if they stay in financial services. Yeah. And by the way, Brett, I'm telling you, I'm launching a SPDB, whom I work with, is launching a white paper at the Ant Financial Conference in September called The Inclusion. And I'm supporting them because I wrote it for them. And we talk about panoramic banking. Just be ready is a new concept.
Panoramic banking. I like that.
Panoramic.
Yeah, no, I get it.
The best translation of the Chinese word that I cannot pronounce that I could possibly find in English. Panoramic banking.
Oh,
Brett right now is putting a trademark on that, so he can own the trademark on the panoramic banking. If it's not,
I got so many, man. Embedded banking everywhere, never at a bank. I got tons of them. I don't need any more.
Okay, guys. I think I was a bit optimistic, thinking that we could talk about two topics in the first 20 to 25 minutes. So I propose that, it's the beauty of the unplanned things. Let's take a break right now, and we'll come back in the second part of the show talking about something that is not completely unrelated, but, is that true that who has the deepest pockets, can win? And basically the topic is Cabbage being acquired by Amex. And we'll start thinking a little bit about, who are the players that are more likely to take a prominent role in the consolidation of the fintech market. With that, stay with us. That's Breaking Bank Europe.
The FTS Group builds innovation ecosystems. We engage incumbents, investors, entrepreneurs, technology partners, and regulators to build trusted and connected fintech tribes around the world. We firmly believe that innovation in financial services will truly improve people's lives. Learn more on ftsgroup.eu.
Welcome to Breaking Banks Europe. You know, guys, the challenge of making a show with practically three hosts that have all more experience than you is that you basically suck at pretty much anything you do. So everyone has his own opinion. So now I'm putting my actor voice and welcome back to Breaking Banks Europe. How about this, Brad? Is that better?
Yeah, let me try it. Welcome to Breaking Banks Europe. You know, is that too dramatic?
No, that's great.
It's not like my Hollywood announcer voice. In a world where Donald Trump has gone mad. No, sorry.
Brad, let me do it flamboyantly. Welcome to Breaking Bank Europe.
That's probably more appropriate, actually.
That's it.
Okay, and by the way, we are not cutting this part of the show. So we are even leaving the Darvador Brett voice. Okay, guys, back to our business. So as I was saying earlier, let's start from this news that Amex has acquired Cabbage in the US. And, it's funny because I always think that back into the InnoTribe times, the very first fintech of the InnoTribe batch was acquired by MasterCard for, I believe, 150 million back then. And we were getting all excited. So it changed names. It was like a digital identity startup. I can dig it out. Of course, I had this name, on my tongue most of the time until 10 years ago. Then I sort of moved on, right? But I'll dig it out. So all this to say that if you think of the first fintech funds between 2010 and 2013, none of them actually got a major exit. I'm talking about the 100 to 200 million fintech funds, the Santander, the BBVA, you name it, okay? Maybe they have done exit because they bought actually startups. But if you think of the MasterCard, the Visa, and the Amex combined, they've probably done one of the largest, most of the largest acquisition of fintech recently. So is there a trend? I mean, is that because this giant cards company, on one side they have more cash, second, is all about payments and data, so they understand fintech better. Why is it? Or is me making patterns where there aren't?
Matteo, let me say this. I remember 4 years ago, I had a conversation in New York with a very prominent venture capitalist. And he said, I've got this portfolio of startup, especially fintech. And you see, I think they're very good. But either we are not selling them as we're expecting, or they are not selling the services the way we are expecting. So I said, let me understand here, whom are the buyers of this fintech or the buyers of these services? And he said, banks. So I said, didn't you realize that banks have no money? Because they don't, since 2008. Now, they might have capital they need to build up, but it's not banks like 10, 15 years ago. So they're very conservative. They have a lot of constraints. Payment companies are already different because they have different margins like Visa, MasterCard, Amex, so on and so forth. Now, having said that, and the situation is changing and it's been improving for banks too, the fact is that we mentioned before, we got payments, lending, investing, and insuring. Now, the consolidation of the industry will follow this path because it's a symmetry of information. So you go from payment to lending because you need to consolidate the relationship with clients. At the moment, your payment relationship can be disintermediated, can be a large, big tech that comes to your market, can be the European Payment Initiative that has been supported by the European Commission and the ECB recently, which is still in its infancy, but might come in due, that will want to, if you like, replace disintermediation mediate the Visa and MasterCard, but they need to build the next relationship. And this goes around lending because that's where they can reuse the data, and because lending creates a sticky network position. So
basically car companies, they're buying because they're afraid.
I think a bit of it is fear, though. I think a bit of it is that, you look at the UK market with the fintechs. Look at RBS Bo, right? Bo was a fear response. They tried to buy Monzo. They were too expensive. They tried to do their own, thing to compete, but they couldn't, internally get it over the line because it takes a fundamentally different organization structure. But I think, right now, COVID is exposing this big gap in terms of digital competence. And, the one measure I keep referring to when people ask me to talk about that specifically is not just the great CX that these organizations have, but if you're a challenger bank user or a heavy, TransferWise user, or Ant in China, you get daily communication, daily engagement from this brand on the digital sphere. They're really, really good at digital engagement. The traditional banks just, they're just not there. Sorry, I'll hand over to you, Jim.
Well, I think we have to remember that the strategies are all going to be different. MasterCard's desire to acquire certain companies is different than Visa's just because of their positioning. And American Express, when you look at what they did with Cabbage, that was a complete strategic play for deepening their relationship with the small businesses. So I think, getting back to our last segment where we talk about the actual value of any company, is going to be determined by the market positioning and what people want to generate from that. So be it an investor in the marketplace or a VC, everybody's going to evaluate where the marketplace is going to be for any of these. And it's not going to be what's interesting about these tech companies is the valuation varies every day. I mean, American Express didn't take on the loans from Cabbage because that would have brought down the value quite a bit. They took on the customer base. They took on what Amazon did, which is, I want the customers. I want the names. I want the people that have engaged. And at the end of the day, it's going to be the number of customers that are truly daily engaged with you more than who's on my waiting list or how much assets you have. The people's relationship is really going to be
Jim, sorry, I want to double click on this because what you just said reminded me a little bit the reason why a BBVA sort of explained why they bought Simple back then, right? So Simple they were 60,000 customers or something. And candidly, talking with, my friends there, but it was almost an open statement. They were they bought it to learn how this 60-something customers that were extremely well educated on mobile, used to use the services, and how could they sort of learn from that way to interact with the app, how to build the future mobile digital services for the bank. So do you guys think, but maybe Jim, since you brought it up, start giving your thoughts. Do you think that is a learning investment, or because I don't know actually how many clients a Cabbage has, but there is certainly, they're certainly neglectable compared to the Amex actual client, unless we are talking about getting into a segment like a small and medium businesses that for Amex is, technically non-existent.
Well, I think the most successful ones of these, they all acquire customers at scale digitally, and that is a big differentiator.
Yeah. And I don't think it's a learning curve necessarily. I don't think it's that Amex didn't think they understood the lending marketplace, for instance. In that case, I believe even though they did acquire the people, I think it's in this case more of a, there's a scaling issue. And they realize more than the traditional banks do that what they want at the end of the day is they want to build a relationship that the banks are letting go. I mean, there's no competition to get these entities back in much the same way that PayPal, the traditional banks let PayPal take payments, and there's not been a whole lot of competition. I'm not too sure if a lot of these future acquisitions are going to be, we need to learn what they're doing. Unless it's a smaller organization, it's going to be more, I'm acquiring scale.
So, Jim, in one of my most successful keynotes worldwide, I used to play a video of Lassie Come Home. You might remember the movie. I was hugging my mom 4 years ago watching it on television. And
this is Lawrence Lessig?
The Lassie is the dog. You remember?
Okay.
I don't know if... Okay, so if the dog gets lost, he can find a different family, but he comes back to his previous owner because they are engaged. They have a relationship. So I used to say not because banks should treat clients like dogs and I love dogs. Okay, that's not the point. But the point is that the user experience is a tactical advantage because everybody can replicate it in the very end. It's like the Wi-Fi in a hotel 15 years ago. Now everybody has it or should have it. The engagement is way more important because it enables you to bring your relationship somewhere else. But you need to feed that engagement. Now, payment was under the hook. There was a time where the engagement was the good Amex card with the membership rewards. By the way, I worked for Amex as a caller for card activation and card cancellation. Back when
everyone should do cold calling once in his life.
Exactly. I learned that. No, because they also learned the importance of the relationship with finance and sell.
When I was a kid in high school, I used to sell roof rejuvenation. I went door to door selling roof rejuvenation where they would like clean the tiles and spray this polymer over the top to protect them. Anyway, it was
it on me, as you can see.
So you remember guys when 4 megabytes in PC costed like $300-400, 4 megabytes? I was selling that over the phone, cold calling Italy from Paris. So yeah, exactly. I know what you're talking about.
I was delivering newspapers. So, that shows
I had a paper out too, man. Yeah.
Oh, yeah.
Okay, so talking, it's actually a good transition because talking about small and medium businesses or like micro businesses, okay? This is, we call this format Building Bridges because Paolo and I are going to share something that we clearly see like this side of the ocean, and you guys tell us if it's the same sort of trend or, in which flavor, this sort of conversation can be taken on. So talking about small and medium businesses, actually there is a series of fintechs that talk about, leasing, factoring, lending, enabling, super fast microloans to SMEs that was sort of in the background before, but right now, certainly because governments need to deliver this money fast because of COVID to SMEs and micro SMEs, it has been pushed forward. This, and of course, but the classical way, but this I am pretty sure is a worldwide sort of tendency or trend, the mobile payments, right? So the new experiences in payments. But I don't want to talk about this. I just want to talk about this new array of businesses to leverage and push forward, this bottom of the pyramid tissue,
So are you saying sort of like those exceptional areas where people have come in and created new value because they're doing something different? Right. So where there's a divergence from sort of the traditional financial services, what I'd call the experience layer.
Okay, so not this, Brett. I was actually told, but maybe it's a good angle to take. I was,
like micro lending as an example, right?
Yes,
it wasn't possible before, right?
Micro lending, but to traditional businesses.
Okay.
I just want to say this. I think this is super interesting. Matteo, effectively, we dedicated quite a long time in discussing how to improve this area, which touches a fundamental component of the economy. There is just one element that I want to put on this podcast. The assets needs to go somewhere. The liabilities follow. So there is a tendency of improving the experience for that because ultimately exposures can be digitally securitized, you can say that. So we need to be very careful to have the full picture when we talk about these businesses from the technology point of view, because if in the end it goes into collateralized loan obligations, there may be the next thing after the collateralized debt obligations. and that will not be good because it will fire back anytime soon. But whatever banks and fintech can do to facilitate access to funding these days in the post-pandemic world is super important and super strategic for everybody. So I hope that everybody and regulators as well understand that fully to move it forward for everybody's benefit.
I will say that, I agree to some extent with what Paolo's talking about. But for me, as you guys know, I'm really, really interested in the sort of the behavioral element, the connecting the dots, And I think if you think about the SME thing and Cabbage, I think, and, sort of coming back to, why these businesses will be acquired and why it's happening right now is, if you look strategically, coming off the back of coronavirus, I think banks are going to be very risk adverse lending to businesses, particularly as these businesses are all under pressure.
They've already announced it.
Right.
They've already announced it. But I mean, Wells Fargo and Chase have already said no small business loans, no home equity loans. Yeah.
And so if you're just using Dun & Bradstreet, scoring, right, or credit agency scoring to assess a small business, you are going to be out of the game, right? But if you use behavioral data, if you use cash flow data, if you've got a different algorithmic view to lending, you can actually do quite well in this space. Look at Lending Club after the last crisis. One of the reasons Lending Club had a much lower default rate than the banks coming off of the 2008 Great Recession was they had better data, and one single data point became really critical for predicting default risk, which was how do people pay their telephone bill on time. That was that single data point was far more successful at predicting default risk than credit score ever was. And so when you look at what's happening in the acquisition space, I think there's a lot of that sort of thing going on where people are saying, look, they're very good at acquiring at scale, and they've got sort of a magic sauce, a secret sauce there, which is a different way of assessing risk or a different way of segmenting customers, and understanding them than what the traditional FIs have. And so I think that's where the action is.
Yeah, I'm going to take it a different angle and say that when you look at the valuation and what may happen going forward, when you look at platformification, when you look at open banking, the potential to bring revenue from outside sources to supplement and complement the traditional revenue sources. I bring up CaixaBank, where they, with Imagine, have brought in, they're going after the millennial marketplace, but a lot of their revenue, the way they make that business model work, is not from the customers themselves. It's from all the partnerships they brought in to access the data or to provide services to the segment they've gone after. So what's going to be interesting is organizations that can bring in additional value from outside. That's going to go into the revenue stream. So let's say it's a small business. You can localize this. So if I can build a relationship with consumers and say, here's special offers from all your local merchants, that makes the value of the relationship stronger and the overall revenue stream stronger for the financial institution. So you can bring it in from both sides in much the way that Bank Mobile had done that with the college students. They found a way to get the educational institution to pay part of the ride to make the product more valuable overall. Yet, they've gone the route of moving, Brett, with now becoming a technology company and saying, we're going to provide a platform for others, which is another valuation altogether. It's a moving target as to how people are going to be evaluated and valuated. And I think, gets back to what Brett said, it's not going to be just the assets liability. There's a whole lot of dynamics here. And the value placed on technology and on customers and the valuation of the customers themselves, relationships, is going to be paramount.
So guys, we need to wrap up, but before we do that, I want to actually talk about something that is completely unrelated to everything we talked about right now, and it's about the three of us are basically representing three podcasts. I'm the new kids on the block, European side. Jim, you have a very successful format, which is a one-on-one, and Brett, of course, is the the father of us all, exactly.
Yes, exactly.
And Jim's
I don't want to say the king because it's too obvious. Come on, but we have
just through having done it for 7.5 years, I guess, right? But
exactly. So we have to pay this respect. And I was thinking that what we are doing this right now could be actually done live with the possibility of the users to steer the conversation by insisting on the topics that we all bring to the table want to be discussed.
So the way we do the way we should do this, guys, is and I've been thinking about doing this for a while, and I know Jim has been thinking about it as well. But I think we need to do some live YouTube with some super chats, and make it a Q&A. Let's say to people, all right, this is FinTech Friday. We do it once a month, FinTech Friday with the hosts with the mosts, and you go and just ask us whatever question you want. Neil deGrasse Tyson does a similar thing with Star Talk, where he does these cosmic queries, he calls them. Now you have to submit them in advance through Facebook and Patreon and so forth, but we should do it live. We should do super chats live on YouTube. It'd be great.
Exactly. So, and the reason why I was launching this discussion here is because if, like, the three of us already start engineering it, it can become something pretty impressive. Jim, what do you think?
I agree. As Brett knows, that we've talked about the ability to do a regularly scheduled town hall type meeting where you can have you have a Zoom situation where you have so many people on the screen, but you have certain people that are being asked the questions, or, I don't know how it works, but can you have a live forum where anybody at any category can ask somebody else on the screen something that they say, you're probably the best at knowing this, and how the interaction happens. If people interact, if people participate as opposed to simply being listeners, it's an exciting platform, something we never thought about because, you can bring so many or so few into the equation. I don't think it would get out of hand. Heck, we've done, how many now, Brett? About 8 people on a call at the same time, and you kind of keep order. But I think that's a great opportunity. I think it's certainly something that Breaking Banks has a platform to do right off the bat.
No, let's do that. I'll get Katie to help us set that up, actually, because she's done them before. So
I love when we make a live announcement in the show. It's great.
Well, and you take that a step further and you transcribe it into articles that people can read. It's a matter of reusing the dynamics of the platform, and then you do the video shorts to say, here's the highlights of this thing, because people want to know what's going on, and this would be live news.
Jim, Brett, thank you so much for building bridges with Breaking Banks Europe today. I hope we'll keep doing so. And see you soon around, either don't forget, and hopefully physically.
And don't forget to check out Banking Transformed while you're at it as well. Jim's podcast.
Exactly.
Yeah, thank you.
Exactly.
Thank you very much, guys.
Guys, thank you very much. It's a wrap.
Thank you.
Stay with us.
Ciao.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with FinTech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.